A quiet summer morning for once. We like that. Live from New York City this morning. Good morning, good morning. Equities just a little bit positive for a second day, up by 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York coming up. Fed officials say higher rates are needed. China signals more economic support and an early breakthrough for NATO. We begin with the big issue, the big bond market debate.
There's a lot of investors who are, really looking at the bond market.
Yields.
I don't really see that much more upside.
70-80% probability that yields have peaked in this cycle.
The market is expecting yields to fall dramatically lower.
The real action, as you said, is really in the 10-year.
The end game is likely lower.
Back down to where it was.
Who knows what happens between now and then?
This is a buying opportunity in bonds.
You're not getting paid to take the risk there.
The pain trade really is in the bond market.
So you have credit spreads widening out.
It does warrant treading carefully.
It wouldn't surprise us if you're looking at 700 plus on spreads.
Let's see what the data is telling us.
The stronger the data comes in,
the more the Fed hikes.
at some point, you will see something break here, and I think it's going to come from the credit markets.
Joining us now to discuss, George Goncalves of MUFG, Kathy Jones of Charles Schwab. To the two of you, thanks for being with us. Kathy, first to you. Have yields peaked for this cycle?
Yeah, we think there's a pretty strong likelihood that 4.25 to 4 1/3 that we got last October is the peak of the cycle. But really can't rule out the 10s going back up and testing these higher levels because the Fed continues to hike. So you have to sort of guess how deeply inverted the yield curve will be. We don't think it gets a lot more deeply inverted than -100 or so. So that probably puts the downside at a higher level than we had previously anticipated. But I think the peak has probably been seen.
George, do you agree?
Look, even if it has been seen, we could probably still retest it. This has been a very unusual hiking cycle, super aggressive, very fast from a low level of rates. Meanwhile, the whole term structure pretty much traded under Fed funds starting in late Q4 of last year. So the bond market's been skeptical throughout this whole period. And what really gets you is that final kind of sell-off, and it could happen now.
Kathy, what's more important from your perspective, that rates are going higher at the Federal Reserve or this cycle is lasting longer?
I guess it's that the cycle has lasted longer. I think it's important that the Fed continues to signal that they're going higher, and that means, further and further weakness down the road. But the longer they hold, the more there, in my opinion, risk of some sort of market accident or some sort of, economic accident. So we already had the banking incident, as Paul called it, in March. And I think the longer the Fed stays on hold, the higher they go, the more risk there is that we see other market incidents that take place.
SocGen agrees is something they've said too. And George, it raises a question. I know you've pushed out your rate cut call into next year. How do you look at short rates at the Federal Reserve and push it right the way through the curve?
Look, this is a Fed that wants to stay on hold. The question is, will they have the wherewithal to stay on hold? That's really the question that we're all trying to determine. They did an amazing job of taking out the cuts for 2023, but they can easily come back, as we're all kind of concerned about something breaking out there. So I think, at this point, the bond market in the short end is respecting the Fed, but out the curve, we're still skeptical.
Well, let's talk about the prospect of something breaking. Carl Riccadonna over at BNP Paribas. This is what he wrote in the last 24 hours. U.S. consumers have spent at an above-trend pace over the last couple of years by leaning on excess savings built up over the course of the pandemic. Him and the team went on to say this dynamic is fading. It looks set to end soon, with excess household savings likely to be depleted by year end. I want to pair that with the view over at BNP on credit. Our study of bankruptcy filings for smaller, mostly private companies shows a default cycle is already underway. Now, Kathy, if I look at high yield spreads, a very specific part of fixed income right now, high yield spreads are something like 400 basis points. And for anyone not familiar with the credit market, that's really pretty tight. That's pretty tight, which means credit is pretty buoyant and things at the surface, at least, look OK. Beneath the surface, Kathy, do you see something similar that I'm hearing from Megan Robertson over at BNP Paribas, that their study of bankruptcy filings for smaller, mostly private companies is showing a default cycle is underway?
Yeah, we are seeing the same thing. So those bankruptcy filings are up pretty sharply. And we've been concerned about the private credit markets for quite some time, simply because there hasn't been sort of a mark to market, right? A moment of reckoning where they've had to come in and say, okay, well, that's, we're going to write things down. They're starting to write things down, but we haven't seen it actually happen yet to the full degree or realized in the public markets. So we do think that as you get the student loan payments coming back online, you're seeing a lot of trouble with financing now in the auto sector. Credit card charge-offs are picking up. Bank lending standards are tightening. All the components you need for some sort of at least a mini credit crunch or deterioration in high yield are there. They just haven't panned out yet. Maybe because a lot of companies have termed out their duration for another year or two.
George, just how resilient is this economy? And if we get those payments resuming on student loans later this year, does that lead to a soft patch for economic growth, or is that something we can weather?
Look, I do think that that just compounds the issues on the consumer side for sure. And to go back to the SMEs, I mean, we are seeing a kind of bifurcated credit market. In many ways, the credit, public markets, are very tribal. As long as there's cash to put to work, and asset allocations have not shifted away from high yield, money's going to keep going back into that market. But at some point, this SME kind of being cut off from credit, the credit crunch is starting from the banking side. It works its way into the capital markets. At that point is when we're going to see, actual losses pick up into the actual, high yield market as well. But that's down the road. And so until that happens, you can stay with a very tight spread. But nonetheless, I do think that a credit crunch is on its way.
George, are you of the opinion that a process started several months ago with the failure of a couple of those banks in the United States, so that starts to spread in the months to come? We get bank earnings on Friday. Are you expecting to identify any of those themes, some of those issues starting to come to the surface?
Yeah, I think we're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. We're going to see that the regional banks probably have to come to terms with loan loss reserves, especially around CRE, and we're going to see probably less credit origination in general. So I definitely think that this earnings season is going to be super critical.
Bank earnings on Friday, CPI tomorrow morning. Going into that CPI report, 3 separate Fed officials making the case for further rate hikes this year in order to bring inflation back down to 2%. Enda Curran joins us now for a little bit more on that. Morning, Enda. Your view on where this Fed is going?
They seem to be cementing that July rate hike, John. As you mentioned, Michael Barr, Loretta Mester, Mary Daly, all coming out yesterday making the point that inflation remains the #1 priority. It remains too high, and that they see at least another rate hike, if not a couple of more rate hikes, for the coming year. Now, there was one standout yesterday. That was Raphael Bostic, who made the point that he thinks interest rates are already in restrictive territory. So he sounds like someone who would probably prefer to hold policy on hold. We do, of course, have inflation tomorrow. All the focus will be on the core numbers. But judging by the commentary from those 3 Fed officials yesterday, you'd have to say the July rate hike looks like a done deal now at this stage.
And John Williams, the New York Fed president, speaking to Colby in the Financial Times, had this to say: "I don't have a recession in my forecast. I have pretty slow growth." I've got a counterpoint to that from Torsten Slock over at Apollo this morning, a timely one. He said the lagged effects of Fed hikes will continue to drag this economy down over the coming 12 to 18 months. That is why a recession is more likely than a soft landing. Enda, can you frame that debate for me right now? Who's got the stronger argument on the FOMC?
Well, right now, I think the so-called softer landing crowd are winning. Clearly, the jobs market's holding up better than expected. John, other sectors of the economy also holding up. But to your point, though, there's still a big question mark about where will we be 3 to 6 months from now when those interest rate hikes over the past year or so start to bite. Some hints of consumer spending is slowing down. You see some hints of softening in the jobs market, for example. So I think the debate right here, right now, is being won by the soft landing crowd. But, 3 to 6 months from now, it could be a different picture.
And let's just wrap up by leaning on your experience over in Asia as well. I looked at our reporting from our colleagues overnight when I woke up this morning on the Bloomberg terminal. Just some more suspicion, some expectations, fueled actually by Chinese media overnight, that perhaps we get some stimulus out of China. And how targeted is that stimulus effort going to be?
Fairly targeted. The measures overnight via the state press is essentially making it easier to repay loans, or pushing back the deadline for property developers to repay loans until the end of 2024. But, John, that's not going to be a game changer for the overall property sector. There's no sign that the government is coming in to reflate that broad sector yet. And we know, of course, property is 25% of the economy. It's one of the biggest drags on China's recovery this year.
And thank you. Kathy, to you on that, out of China, is that a game changer for you, a push for stimulus, targeted or otherwise?
Yeah.
What China's doing right now is aiming at more political stability and trying to get that economy off the ground. But it's more of a kick the can down the road on the debt area in terms of the property sector. So we don't see it providing a big stimulus to economic growth globally. George, what's your take on that?
Look, everything so far has been incremental. There hasn't been that really big bazooka type event yet, and probably won't come down the road either. I think that China's being very targeted with their stimulus, largely because they're trying to make sure they address the issues locally. And if it benefits the rest of the world, great, but it probably won't. So I think that we shouldn't bank on China really lifting all boats.
Hey, George, stick with us alongside Kathy Jones, just on the latest on China, the United States. In just a moment, we'll talk about Europe as well. Let's get you some moves. We can do that with Abby this morning ahead of the opening bell. Hey, Abby.
Hey, John. Well, we do have a little bit of a reprieve here for the NASDAQ 100 and some of that tech selling that we saw yesterday. And in recent days, Amazon is popping higher, up more than 0.6%. And of course, the Prime Day sale started today. It goes through tomorrow, so that's another positive. In addition, Wells Fargo has named Amazon a signature pick based on faster growth. 3M up 2.2%. It's not often that you see a stock pop that much on an upgrade to a neutral, but that is exactly the case. We do have Bank of America upgrading the stock to a hold. And this is a positive because they've had so many lawsuit issues. They recently settled that $10 billion PFA case. They still have earplugs, but apparently the worst may be over. And then finally, you're talking about JP Morgan and the big banks starting to report this Friday. Well, into that, JP Morgan is up 1.4%, up for a third day in a row, heading to its longest winning streak since early June.
Abby, thank you. Shanali Basak, 9:30 Eastern Time, 20 minutes from now, on that story over at JP Morgan. Coming up next on this programme, big breakthroughs at the NATO summit.
There are ongoing negotiations where we could find a compromise, a clear, united statement on Ukraine. We should give all the possible help for them to meet the conditions of NATO.
That conversation up next.
We should give all the possible help for them to meet the conditions of NATO. Then the other issue is that they would like to have some kind of security assurances. We know that in G7 group, they are also discussing on that. We will get more information in a couple of days from G7 too. So let's see how it will be formulated.
Major breakthroughs coming at the NATO summit. Turkey agreeing to back Sweden's membership bid. Secretary General Jens Stoltenberg saying he will push a fast track for Ukraine, as G7 leaders on the sidelines are set to negotiate over further bilateral security agreements. Meanwhile, the President, Zelensky, slamming NATO for a lack of a clear timeline and forceful tone. Let's get to the team coverage. Bloomberg's Anne-Marie. Maria Tadeo join us now for more. Hey, mates, let's start with a big breakthrough for you. What's number one?
Well, number one, I think, is you have the ascension of Sweden. President Biden is going to be claiming victory about this at this summit. He was able to, within 24 hours of this meeting beginning, make sure that Sweden was given the green light by Turkey. Now, Jonathan, the real crux of the matter for Washington is whether or not they're going to have the votes to make sure those senators that could potentially hold up those F-16s to Turkey, that goes through. I just spoke to Senator Durbin on the phone. This is the Senate Majority Whip. He is here on the ground, and he said those discussions regarding the F-16s were part of the dialogue to make sure they can get Sweden over the finish line.
Maria, how much of a change are you seeing developing from the Turkish side in the last 24 hours?
He certainly is the man of the moment. And Jonathan, we should always stress when it comes to President Erdogan, he plays and speaks to multiple audiences. Obviously, he keeps an eye back home. He always wants to project that he is strong. Yesterday, he was the man of the hour. Every camera, every reporter was on Erdogan. That is what the Turkish people see. This is a leader on the international stage that is cutting deals. Then obviously, we know there's a situation with the F-16s. Now, the Americans will say they're not connected, but in the eyes of the Turks, they are very much connected. And then, of course, you have the international community, potential investments. We know that Turkey wants to perhaps present itself as now a country that is willing to play more by the book. This shows that Erdogan is constructive. And also, in particular, when it comes to Sweden, you also have the religious aspect of this. We know that faith is a crucial point for President Erdogan. He also speaks to the Muslim world. And yesterday, again, he was clear that issues like burning the Quran, he does not approve of. And Turkey will have to keep an eye on Sweden as to whether or not incidents like that continue. So we are seeing a shift. To me, the real question is this just Erdogan being nice at NATO, or actually do we see a fundamental change from the country? And that has significant implications for the economy.
Breakthrough on Sweden, breakthrough with Turkey, no breakthrough with Ukraine. Let's just sit on Ukraine for a little bit more. Anne-Marie, cluster munitions, highly controversial. The president supports Ukraine having them. There's been some pushback from elsewhere. What's the discussion like now on the ground?
Well, pushback from countries that are here, part of the NATO alliance, like individuals that have signed, these countries that have signed up to a convention to make sure that cluster munitions are not used. Because, Jonathan, if they do not explode on use, they could potentially explode years later when a war or conflict has ended. And that is why a number of countries, you've heard from likes of Germany, Italy, France, these countries have signed up to that convention to not use them. They are part of the NATO alliance. Also back home, members of the president's own party are also concerned about sending cluster munitions to Ukraine. What we've heard from Jake Sullivan on the ground here is the president's national security advisor. He talked about the fact that, of course, they wouldn't want to use these, but they really have no choice. Given the fact that Russia is using these cluster munitions, when they talked about the dud rate, the fail rate of Russia's, they say it's about 40 to 60%, and they would not be sending anything like that to Ukraine, where they say the U.S. cluster munitions have a dud rate of less than 2.5%, Jonathan. So they think, given that this is a counteroffensive and given that they want to support Ukraine, that now is the time to do it.
Maria, just a final one. A final question on the prospect for peace. Absent from the conversation over the last few weeks, in fact, the last several months. Have the nations involved in this summit today given up on the prospect for peace anytime soon?
Jonathan, the word peace, frankly, I've not heard this being mentioned in a context of let's sit down and have talks between Russia and Ukraine. The word here continues to be let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield. When you talk to the Ukrainians, they still say very much the counteroffensive continues, and that is the focus. So if you mean, do we sit down and talk now? I have not heard that in not just today and here, but in potentially, as you say, weeks.
Maria, thank you. Maria Tadau with the latest coverage alongside AMH on the ground in Lithuania. Look out for the two of those. The team coverage continues through today on Bloomberg TV and on Bloomberg Radio. With us now, George Goncalves, Kathy Jones for a final word. Kathy, I want to finish in Europe and go straight to the UK. The wage data this morning, a 7 handle on wage growth. The prospect the Bank of England doesn't go just 50 basis points once, more recently, but they have to go again and do the same thing. Kathy, is that a UK issue, or do we have a broader theme here in the West?
Well, I think it's more of a UK issue than anything else. I think the UK has had very unique circumstances in this cycle and continues to deal with those circumstances. And I think that they're probably behind the curve relative to the rest of the G7 nations in terms of tightening. So we see the UK kind of as an outlier here. I do think that inflation will come down, but I think it's a much slower process in the UK than in Europe, where we're already seeing it slow down, and certainly in the US, where we're seeing it come down.
George, UK problem or broader issue?
So, look, I think it is definitely more specific to the UK. Each region and country has been going through these issues in lagged kind of format. In the past, even having said all that, bond markets do trade with some correlation, especially the major bond markets. And so if we were to see continued pressure in UK markets, it could spill into the US. But I'm still focused on Japan, and if they ever do change YCC, that's a bigger issue down the road, more so than if UK rates keep going higher.
George, for a long time, Japan has seen this as a once-in-a-generation opportunity to reset inflation expectations. They've been looking for this for decades. Why would they look to end it?
Look, at some point, you have to kind of think about just the overall, the financial system and just that part as well. So I think that getting some normalization over the course of the coming year is probably something that we expect overall. The timing is going to be the big issue.
Kathy, if we had a change in Japan, have you done any work on what that would mean for Treasury yields? How much spillover would there be from JGBs elsewhere?
It would really depend on the pace and the format that they follow in terms of exiting YCC. But it is something we think about quite a bit and have done some work on. So it clearly, because Japan holds close to $1 trillion in U.S. treasuries, it would clearly have some impact. It'd probably have an impact on the currency too. So it's one of those things when people ask me, what do I worry about? I worry about waking up one day and finding that they've exited YCC overnight. But that being said, I don't think that's what's going to happen. I think as gradually as possible, Japan will try to ease their way out of yield curve control. I don't think that they're in the business of or have see any real benefit from exiting quickly.
If there's anyone left holding JGBs outside of the BOJ, they'd be worried too. Kathy, I'm sure. Kathy Jones, George Goncalves there on the latest in the global bond market. To two of you, thank you. Yields just turning higher at the front end of the curve. Over the last couple of days, they were lower. They were lower again this morning. They now inflect just a little bit higher by 2 basis points, 488 on a 2-year. On a 10-year Treasury this morning, down a single basis point, just south of 4%, 398 going into inflation data tomorrow, PPI data on Thursday, then on to bank earnings this coming Friday. Up next, the morning calls and later. JP Morgan's Jack Caffrey joins us around the opening bell to discuss recession odds for the second half, as seemingly the consensus seems to be you push out the prospect of recession and then just keep pushing out, apparently. That's been a story of the year so far. That's coming up shortly from New York. This is Bloomberg. 5 minutes away from the opening bell, equities turning just a little bit higher this morning for a second consecutive day, up by 0.2% on the S&P. On the Nasdaq 100, up by about 0.1%. That's the price action. Let's get you some morning calls. First up, Wolf Research downgrading Alcoa to underperform, expecting softer aluminum prices amid rising output and weakening demand. Next up, Jefferies upgrading JP Morgan to buy, 165 price target, highlighting the investment bank's stable earnings outlook and diversified revenue profile. That stock is up by 1.2% ahead of earnings on Friday. And finally, Evercore downgrading JetBlue to underperform, pointing to weakening fundamentals and growing headwinds to its balance sheet. That airline in the pre-market, negative 1.5%. Coming up, JP Morgan's Jack Caffrey making the case for quality stocks ahead of a second half filled with question marks. That second half underway. Your opening bell is coming up shortly. Equity futures up by 0.2%. The opening bell 4 minutes away. .22 seconds away from the opening bell this morning. Good morning. Equity futures positive by 0.2%. Positive yesterday to start the week. Let's see if we continue the streak. On the Nasdaq 100, up by 0.1% as well. Just a little bit firmer going into CPI tomorrow and earnings as they kick off on Friday. The opening bell in New York City rings. Switch on the board and get to the bond market. Yields look like this. Treasuries pretty stable, unchanged. 398.60 on a US 10-year. Yields coming in a single basis point. On a 10-year, on a 2-year, last couple of sessions, yields lower. Just think about the range on a 2-year. Intraday on Thursday, post-ADP blowout. We forgot about that quickly. That 2-year intraday 511 this morning dropped to as low as 482.20. With that, some dollar weakness over the last few sessions. This morning, some dollar strength. The euro just a touch weaker. Euro dollar, a break of 110 in one direction, a break of 110 in the other. 109.91 on the euro against the US dollar. Crude a little bit stronger, firmer, higher, positive by 1%. $73 and about 70 cents, just short of 74. 40 seconds into the session, equities up by 0.2% on the S&P 500. On the Nasdaq, up by 0.1. One sector to watch at the open is big tech. The Nasdaq 100 planning a special rebalancing to curb the dominance of its 7 largest companies. The index saying the adjustment will, quote, address over-concentration in the index by redistributing the weights. Abby has more. Hey, Abby.
Hey, John. And yesterday we had some of these big tech stocks, specifically what's being called the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Tesla, Meta, Alphabet, trading lower, with the exception of Meta. Yesterday, Meta did actually get a pop from its Threads popularity and that user surge. But for the most part, these stocks were down 1 to 2%. Today, we're seeing a little bit of mixed action at this point, actually. Microsoft now turning lower, Apple up just slightly, Amazon up slightly, but off of its pre-market lows. So investors are still worried about this rebalancing, and it's a special rebalancing because typically these are an annual or a quarterly event. But it seems that NASDAQ is noticing what investors are talking about, the dominance of these stocks, more than a 50% weighting to the NASDAQ 100. The reason stocks are lower because, of course, index managers, they will have to reduce their positions to the new weightings. We'll know those new weightings on Friday. The actual changes will happen on July 24th. And if that weren't enough, we also have valuation concerns. The Fed, if the Fed suggests in this meeting that they really could be hiking longer and further than expected, that will hit tech. And then, John, of course, earnings for these stocks, it's not until later this month, but lots of pressures here for big tech. And again, mixed action for many of these big tech names.
Abby, looking forward to that. Thank you. Just to stay on tech a little while longer, guess what Dan Ives is of Wedbush? Dan Ives is bullish. He expects a big tech rally to continue another 12 to 15% this year. We believe a new tech bull market has begun to take shape, being led by the AI revolution. We see better than expected 2Q earnings over the next few weeks. There will be winners, there will be losers, but ultimately we see a strong second half ahead for the tech sector after a pretty blowout first half for tech, particularly on the Nasdaq 100. That's tech later this month, as Abby pointed out. The financials, they begin this Friday. Jefferies upgrading JP Morgan ahead of earnings. The analyst writing, while JP Morgan has been a recent winner, we upgrade the stock to buy given a stable earnings outlook, best-in-class ROE profile, conservative reserving history, and better revenue diversity. Shanali has more. Hey, Shanali.
John, JP Morgan is against the pack. When you look at the expectations for earnings season, there's a lot of pressure on the banks, particularly the regional banks. But JP Morgan, already the most expensive of the biggest banks when it comes to a price to book ratio here, is getting an upgrade over here from Jefferies. Jefferies is looking to JP Morgan, Goldman Sachs, and Morgan Stanley to really weather the storm that you're going to see in net interest income, as well as any potential worsening credit standards. When you look at what Jefferies is saying about JP Morgan, as well as what Wolf Research has said, they value JP Morgan for being conservative when it comes to reserving. Remember, there are only 4 banks right now in the KBW Bank Index that are up on the year, JP Morgan being one of them, Citigroup as well, Wells Fargo being another. All 3 report on Friday. Interesting note that Jefferies makes about Morgan Stanley and Goldman Sachs. While they prefer them, Daniel Fannon over at Jefferies is also looking at they call it a tough everything when it comes to sales and trading. They reduce their second quarter EPS estimates for those 2 banks, even while preferring them as a bank, because they are worried about what those numbers look like when it comes to investment banking sales and
trading. Can we just dig into loan loss reserves, Shanali? The FT wrote up a nice story yesterday, actually leaning on some of the data that we have from the analyst expectations around loan loss reserves and loan losses. How bad is this going to be on Friday?
I think you have to watch 2 things at the same time, don't you? You have to watch how much people are reserving for the next couple of quarters in the next year or so, but you also have to see how much those loan loss reserves are converting into credit losses. We are starting to watch some deteriorating conditions, and you're seeing aggregate data show you here that credit, auto, that you're very worried about credit cards and auto loans, and a lot of these banks have bulked up on credit card debt to their consumers to boost NII. If you look, when we were talking about that KBW Bank Index, actually the number 1 performer is Capital One. They're up a whopping 17% on the year, and they report next week. And so I think you have to watch both the banks and the credit card companies at this time. There's a lot of worries, even when it comes to Goldman Sachs, about their commercial real estate book. So I think it's going to be a very messy quarter here when you look across all of the loan books across all the different banks.
Shanali, thank you. Kicking things off Friday, JP Morgan, Wells Fargo, Citi. I want to get to Uber. Some changes in the C-suite. Nelson Che the CFO, planning to step down, marking the most significant executive departure since the company's IPO. The company saying this in a statement. Over the past 5 years, Nelson has been essential to putting Uber on secure financial footing and steering the company from billions of dollars in losses. Bloomberg's David Welch joins us now for more. David, the stock's down by about 1%. How significant is this move?
I think Nelson Che brought a lot of stability to the company. He's very respected. Before Uber, he was at CIT, he was at Morgan Stanley. I think on Wall Street, very well liked. If you look at what's happened over the past few years with the company, they went from this huge, crazy push for growth that cost them a lot of money. He reined in costs, even while they were diversifying into freight and goods delivery. So they've got more diverse sources of revenue, pretty good growth still, but they've got positive EBITDA. What they don't have is net income. So I think there'll be some questions here from investors. Who's going to come in next, and what does this mean for the next phase of the company? Because Uber still has a lot of challenges ahead. Even though they still have growth and they've kind of reined in costs and they're closer to net income, they still have never posted actual net income, and they're under a lot of pressure. There are moves in New York City and other major markets to push up the pay for the drivers. There was a recent LRB ruling that says their drivers can unionize, which could raise their costs. And a lot of their positive EBITDAs come from raising their rates for Uber for their fares. How long can they continue to do that? So there's still a lot of challenges ahead for the company, and they're going to need a steady hand at the till to keep costs in check and help the company continue to find growth.
David, this comes in many cases without any real competition from Lyft, which has been struggling much more, relatively speaking, to Uber. Are you describing just a problem with the industry then? Is this just a difficult industry to make money in?
It is, and it has been for a while. And look, remember, years ago, everybody said you couldn't make money in ride-sharing, ride-hailing without autonomous vehicles. Now that autonomous vehicles are sort of a big question mark themselves as to how well they're going to work and when, people aren't really saying that, but that is kind of working on the distant horizon, isn't it? When you've got General Motors with Cruise and you've got Google's Waymo out there offering ride-hailing with self-driving vehicles in a few different cities right now, that could change the game and really make it tough on Uber and Lyft. In the meantime, it is a big question. How are they going to make money? And even if they get into the black, what kind of margins are we seeing from that business?
Stock down 1.5%. David, appreciate the update. David Welch there out of Detroit on the latest from Uber. I want to turn to some fresh M&A news. Berkshire Hathaway purchasing Dominion's 50% stake in an LNG facility for $3.3 billion. The company writing this: "We're proud of our operations at Cove Point, excited for the opportunity to increase our ownership in these world-class facilities." On a story, here's Katie. Hey, Katie.
Hey, John. Well, Warren Buffett's Berkshire Hathaway now owns 75% of Cove Point after agreeing to pay $3.3 billion to buy out that stake from Dominion. Now, for some context here, Cove Point is a Maryland LNG plant that Berkshire first took a stake in back in 2020. It's one of just 7 operational U.S. facilities that's able to export LNG right now. And now Berkshire controls it. And for their part, Dominion said in a statement that they're going to use these proceeds to repay debt. And of course, this deal comes after natural gas prices surged in 2020 after, of course, Russia invaded Ukraine. But so far this year, prices have dropped more than 50%. And if you look at the reaction in the share price, you can see that Dominion under pressure right now, Berkshire up a little bit. Usually it's the opposite dynamic, John.
Katie, thank you. So far, their stock is negative. Dominion, at least. The broader market so far up by 0.3% on the S&P 500, 9 minutes into the session. This follows the best first half on record, leaving strategists very divided over where stocks are heading next. RBC's Lori Calvasina weighing in.
I personally feel pretty neutral. I don't feel like the market's been crazy. I do see the potential for some upside, but this is a December 31st game.
JP Morgan's Jack Caffrey planning to navigate the uncertainty by staying up in quality, writing this: "One measure of quality we think is compelling is from growing dividends. They're a measure of earnings quality. Encourage management discipline and align the interests of management and shareholders." Jack Caffrey, I'm pleased to say, joins us right now. Jack, I actually wanted to start in the housing sector, where you've really helped lead us through some pretty good moments, actually, for housing. Home builders on the S&P 500 have been absolutely flying. Can we just start with the broader industry? Are we seeing housing trends improve, Jack? Are things actually getting better?
Well, I think when we look at housing, you really have 2 markets. You have the market for new construction, the home builders, which has been on fire because that's really the only supply. The market for housing turnover has remained really quite sluggish, when you look at mortgage rates that are 150, 200 basis points above what the average consumer is carrying. So you actually have seen the consumer forced to stay in their home. And so I do think we're going to continue a bit of a tale of two cities, with the best of times being the builders bringing supply, and the worst of times being still that housing turnover, especially if you were looking to move into something bigger. You just can't find anything, to say nothing about the cost of actually trying to make that move. That makes me think that actually renovation might be the way forward in the existing home stock.
Jack, how much is renovation, the likes of, say, a Home Depot, lagged what's happened with the home builders so far this year?
Well, sure. Looking at the home improvement chains, that they have actually been spending very aggressively, Home Depot and Lowe's, and trying to become more pro/contractor friendly. But that winds up being 30, 40% of sales. That leaves 60% coming from you or I having, well, actually my friend or my son going into Home Depot in order to actually get the wet vac to clean up after the flooded basement. That actually is a nice little pit, nice little driver. I do think that you have seen some of those costs coming down as you've seen lumber prices falling, bringing in some deflation into the top line, but improving some of the margin story going forward. You are also seeing some pressure on labor, and that's not just a Home Depot home improvement channel, that's a broader retail channel, and that actually, I think, supports the idea that the consumer remains engaged overall. People are working, unemployment's low.
What they're not doing, though, Jack, is taking credit. We saw some of the credit growth numbers yesterday actually pretty low. As you've pointed out, people aren't moving. They don't want to give up 3% mortgages. I don't know many people who want to take on a 7% mortgage. Jack, is that a reason to avoid some of the banks?
Well, I think there are two parts to the bank story. Right now, certainly the mortgage market is not going to be helpful. I do think we're going to be watching credit trends very carefully on Friday. And I think even before we start talking about losses, what are we going to see with delinquencies? You are, I think, especially when you start thinking about credit cards, you're starting to talk about those are loans that are pricing and costing the consumer, for a consumer who's stretching, 20+% on their credit cards to low mid-20s, for a consumer not actually paying down balances. But if the consumer works, generally that's still a constructive backdrop. We've also heard lots of noise about how weak the capital markets are. And so you've seen a lot of fee pressure on the banks, and the more diversified the bank, to some extent, the more pressure they've been under, whether it's lack of M&A, lack of capital markets activity, lack of trading activity. So it does mean, I think, focusing on what's the pressure to raise focus and pressure on net interest margins, as well as what the credit experience looks like. Right now, the credit still looks fairly robust. I think that's reflected in other market measures. Credit spreads remain relatively tight.
Jack, the word defense means different things to different people. What does it mean to you?
Well, I think defense historically would have been looking to places like utilities and consumer staples. And those groups have traded very much like bond proxies this year, with, as we pointed out just moments ago, when Dominion was selling assets to Berkshire Hathaway, stock has actually been fairly weak, and they're using that to repay debt. Consumer staples, you wind up looking at stocks that are trading like that they are almost secular growth stocks, and yet their customer base is not actually expanding all that dramatically. They've been leaning very heavily on price, and retailers are now starting to push back on that price. I think that makes the less traditional sector that becomes more high quality and more defensive healthcare. You're starting to see better utilization. That has pushed and put some pressure on some of the health insurance companies, but points to better volumes, better trends in some of the medical device companies, some of the healthcare facilities companies, which benefit from control pricing, better labor, which actually gets you better utilization, and offers you actually some dividend growth as well. So you can come back to healthcare broadly, a sector that's cheaper than market, has better growth than market, has better income than market, albeit it's hard to find one or two stocks that actually offer you all three of those things in one basket. And I think it comes back to why you can't just buy a single stock and say, that's my view. It comes back to a bit of a diversified portfolio context.
True. Jack, appreciate the input, the insight. Jack Caffrey there of JP Morgan. 14, let's call it 15 minutes into the session. Equities up by 0.1%. Coming up, media and tech moguls gathering in Sun Valley.
I would not put high odds on a transformative deal coming out of Sun Valley. We're in a moment of sort of reassessing and rationalizing.
The summit in Idaho getting underway. That conversation coming up shortly.
I would not put high odds on a transformative deal coming out of Sun Valley. I think we're at a part in the narrative where we went through a flurry of transactions as everyone tried to scale up to lean into streaming. And I think for the most part, the losses have been larger than most people expected. And now we're in a moment of sort of reassessing and rationalizing. It doesn't strike me as a period for transformative M&A.
Tech and media giants gathering in Sun Valley, Idaho, with AI, streaming, potential mergers all in focus. This as Microsoft cuts hundreds of jobs in a new round of layoffs, and Amazon's Prime Day kicks off. Let's get to the coverage. Bloomberg's Ed Ludlow, Poonam Gaur joining us now for more. Ed, describe Sun Valley for me. Isn't that the episode in Succession where they go around in those vests and walk around in the valley? Isn't that it?
Exactly so. Summer camp for billionaires. It's interesting what that last guest said, though, because the focus this year is back on TMT. A year ago when I was here, it was only one story, Elon Musk's purchase of Twitter, and he was the surprise guest. But there are two deals we're focusing on. One is the future of Hulu. Comcast owns 1/3 of Hulu, but they have an agreement in place that they can require Disney to buy out that stake. My understanding is that Brian Roberts of Comcast is not here, but Disney leadership is, including Bob Iger, of course. The other, it's not happening here, but it is Microsoft's $69 billion purchase of Activision. Any day now, a San Francisco judge will decide whether or not to grant the FTC's injunction for a temporary pause on that deal. Bobby Kotick, the CEO of Activision, is a regular attendee of Sun Valley. My understanding is that he will be here, and that could happen in the coming days. So those are two deals we're watching closely. Whether they're transformative or not, in the moment, there is this focus back on TMT, back on the future of this industry, which was missing in the last couple of years.
Ed, thanks for that. Poonam, let's talk about what's happening with Amazon Prime Day. Just how important is Prime Day to this company still?
It's still very important. It's actually about 8% of the quarter's sales, we estimate. So clearly a lot of business will be done today and tomorrow.
How big are the price cuts, Poonam? When I look at Amazon now, I don't think of getting a better price. I think of convenience. I was talking about that a little bit earlier this morning. Is it still pretty competitive?
It is. I was looking at some of the deals earlier today, and one that stood out was a Dyson Airwrap that people have kind of gravitated towards for years now. It was 20% off, sold out already. So there are price cuts. Some are as deep as 60%, on Amazon-owned products like the Blink. But if I look at it from yesterday to today, the price cuts on average from just what I'm seeing is probably another 10-20% reduction from what you're typically seeing year to date.
But Ed was talking about streaming. Can we finish there with Amazon? We know that the studios business within Amazon for Prime has released some pretty decent moves, including Air, over the last several months. How significant is that to the overall business?
So Prime Video is very important, but it's also taking up a lot of capital, right? So I think as they invest that capital, advertising is what's going to drive the future. Currently, advertising is about $40 billion in revenues. We think it can continue to outpace growth even beyond AWS over time, as it is a high profit margin business that will continue to help Amazon's bottom line, which the retail business has, taken up a lot of.
Amazon this morning up by about 1.8%. Poonam Gaur there. Ed Ludlow on the latest for tech and for media. We'll stay on top of that through today. Equities right now on the S&P 500, slightly positive by 0.1%. Let's get you some sector price action. Here's Abby.
And Amazon just one of two of the Magnificent Seven that are higher today. We'll be taking a look at that weakness in a moment. But first, if we take a look at the sectors for the S&P 500, a small gain really being helped out by the bulk of sectors. So decent breadth. Materials up top, up about 0.9%. 3M rallying on an upgrade to neutral over at Wells Fargo. But tech and communication services, both of those sectors are down. Let's take a look at something, John, that we've not seen this year. That is the NYSE FANG index. It's now down 4 days in a row. That's the first time we've seen that since December. So this selling for big tech, it's not huge, down 2.1%, but nonetheless, it's consistent. So investors worried about the rebalancing, valuation, the Fed, plus earnings later this month. Again, most of these big tech stocks are lower, including Apple and Microsoft, but Amazon, one bright spot there.
Abby, thank you. Your trading diary up next. Day two of gains, second day of gains on the S&P 500. Minor gains, though, positive by 0.1%. That's the price action. Let's get to the trading diary. President Biden meeting with President Erdogan of Turkey. That's at 11 a.m. Eastern Time. about an hour and 5 minutes from now. Then we get CPI tomorrow morning, the main event for many of you on the economic side, of course, for the market as well. Plenty of Fed speak, Barkin, Kashkari, Bostic, Mester, all ahead of the Fed releasing their beige book. Look out for that. We'll get US PPI on Thursday, plus another round of jobless claims. And then we round out the week with kicking off earnings season, with JP Morgan, Citi, Wells Fargo all reporting, going into next week to round out the rest of the big banks on Wall Street. Looking forward to that coverage. Plenty of action tomorrow, no doubt. Bit of a snooze this morning. That should pick up tomorrow morning when we get CPI data and push ahead to earnings as well. About 26 minutes into the session, equities firmer by 0.1% from New York. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.